Welcome to the deep dive. Today, we're really cutting through some pretty intense competition in the crypto derivatives market. We're going to look at a platform that's, well, it's become a really dominant player pretty fast, but its ambitions, they seem to stretch way beyond just being an exchange. We're talking about Hyperliquid.
That's exactly right. Yeah, Hyperliquid is, it's a really fascinating case because you've got this high-performance layer one blockchain, right? And for the last 2 years, they've just relentlessly focused on building one thing, basically.
Yeah.
This huge successful product of perpetual futures DEX. And they got this massive, organic growth. Strictly product first.
Yeah.
Self-funded too.
Right, and that phase is now sort of shifting. There was a big catalyst dropped in September 2024, didn't it? The end of their points program. And the announcement of their native token, HYPE.
Yeah, the TGE. That's really the launch pad for, well, three huge transformations. You've got the Hyper EVM deployment, serious validator decentralization coming up, and they're planning to open source their core code eventually. So they're really moving from this, specialized exchange chain to a whole financial ecosystem on chain.
Okay, so this is where we need to focus because this transition, it brings up a key tension, doesn't it? You, our listener, probably know critics have been quick to say, look, it's currently running on just 4 core team validators, centralized. So the question isn't really if they'll decentralize now the token's here, it's how. How can they possibly keep that incredible performance, CEX beating speed, when they open the network up? That's kind of the core mission for us today, figuring that out.
Absolutely. And to understand if that balancing act is even possible, we really have to start with the core engine, the source of that speed.
Okay, let's unpack that engine then. So Hyperliquid is a sovereign L1 blockchain, and its main thing, its flagship app, is this fully on-chain order book, Perp DAX. And when you look at the team backgrounds from places like Harvard, MIT, Caltech, even Citadel, you kind of get why throughput is their main metric.
Oh, yeah. The wow factor really is the speed. We're talking sub-second latency. While the network is processing over 200,000 orders per second.
200,000?
Wow. And they manage this using a custom consensus mechanism. It's called HyperBFT, inspired by hot stuff.
Okay, hold on. For those of us not, diving into consensus protocols every morning, what does HyperBFT actually do differently? How do they get 200K orders per second without losing security or finality?
Well, it boiled down to something they call optimistic responsiveness. See, most high-throughput chains, they have these built-in time slots or waiting periods between blocks that creates lag.
Right.
Hyperliquid basically cuts that out. HyperBFT aims to get blocks produced and finalized almost instantly, as fast as the validators can communicate round trip.
So less like waiting for a train schedule. More like instant messaging.
Exactly. They prioritize getting the block confirmed and finalized now, makes transactions feel, immediate.
That technical focus is pretty impressive, and it's let them expand their offering quite a bit. They rolled out 2 important upgrades recently, right? HIP1 and HIP2.
Yeah, and these aren't just minor tweaks. They're really strategic moves, aiming to become a comprehensive venue. HIP1 brought in a native token standard that lays the groundwork for spot trading on the chain itself.
Okay, spot trading. Makes sense.
And HIP2, which they call Hyperliquidity, lets users permanently commit liquidity for those spot order books. It shows they're serious about being a full-service platform, not just futures.
And the market seems to agree. The validation for this approach, it's kind of overwhelming if you look at the numbers. Their year-to-date daily average volume, it's huge, $1.05 billion.
Staggering, really.
They even hit a peak of $4.2 billion in a single day back in August.
Right. And here's the really crucial bit. The thing that proves this isn't just incentive farming or points chasing. The activity is genuinely organic.
How do we know that?
Well, look at May. The points program was paused then. Daily average volume, still $818 million. Robust.
All right.
And then in October, after the token announcement, but still no active incentives running, volume was even higher. $1.11 billion daily average. People are clearly using it because the product itself is just better.
That inherent value, it translates directly into market leadership, doesn't it? If you look across, say, the top 10 perp DXs, Hyperliquid holds, 27.5% of the cumulative trading volume?
Yep, but the even bigger indicator, I think, is active traders. Engagement. They command almost 43.7% to be precise of the market share among active DX traders.
Yeah.
That's nearly 10,000 unique daily traders on average.
10,000 a day. Wow. And this isn't just phantom activity, right? It's backed by real money, serious financial health. Their liquidity strength seems significant.
Very significant. They currently hold $700 million in native USDC, bridged from Arbitrum.
$700 million.
And get the The sources we looked at pointed out that this is nearly half of Arbitrum's entire native USDC supply.
Half. Wow. That really speaks volumes about their depth and reliability.
It really does, and it leads us perfectly into the next part of this conversation, which is why they seem to be outcompeting rivals, both centralized and decentralized ones.
Okay, let's tackle CEXs first. Advantages over centralized exchanges. The arguments seem pretty compelling, especially, after all the volatility and collapses we've seen. Hyperliquid offers way more transparency, for one. Reserves are publicly verifiable, right there on the Arbitrum Bridge contract.
That's a big one. Trust but verify.
And of course, there's the accessibility. No KYC. That opens it up globally.
Definitely. Plus, they offer something innovative. CEXs just can't match. An active yield opportunity. It's called the HLP Vault, Hyper Liquidity Provider Vault.
HLP, right. What does that do?
Users provide USDC liquidity. It helps facilitate market making, handles liquidations on the DEX side, and this vault, it's generated $38 million year to date.
$38 million.
Yeah, with about $172 million USDC locked in currently, it's become a really attractive yield source for big LPs.
Okay, so clear advantages over CEXs and transparency and yield. What about other DEXs? How do they stack up against their decentralized competitors? Seems like the advantages there are more structural because of that L1 architecture we talked about.
Exactly. Most perp DXs, they use an off-chain sequencer or an off-chain order book for the actual execution speed. They only really use the blockchain for the final settlement bit.
Right, kind of a hybrid approach.
Yeah. Hyperliquid is different. It's truly fully on-chain. Everything, critical liquidations, funding rates, solvency checks, it all happens right there on the layer one.
And that's only possible because they built the chain specifically for this, right? For high-frequency trading.
Precisely. It was purpose-built.
And that purpose-built infra, it translates into that user experience traders seem to love. Feels like a CEX almost. Transactions are gasless. Latency is super low. And you only need a wallet confirmation for moving funds in or out, right? Not for every single trade.
Correct. It feels very seamless once you're funded, which is huge for active traders. And maybe the final structural advantage, which is, I think, crucial for long-term trust, is that zero VC funding model.
Ah, yes, you mentioned that earlier.
Their focus has been community first from day one. It's fostered this really strong culture, which is essential groundwork, really, for the decentralization they're about to undertake.
That makes sense. This focus on structure, it leads us nicely to the three big pillars of expansion, the things unlocked by the HYPE token. The first one, and maybe the most complex from an engineering standpoint, is deploying the Hyper EVM.
Yeah, this is a major technical decision. They aren't just like switching everything over to a standard EVM. They're implementing a dual VM architecture. Two virtual machines working together.
Dual VM, okay.
They're keeping their native Rust-based Hyper VM. That's what handles the super high volume trading engine, the core DEX. And then the new EVM provides generalized block space. For other applications, think lending, options, stablecoins, DeFi stuff.
But hang on, why make it so complicated? Two VMs, why not just upgrade the core VM to handle everything?
Yeah, it's a good question. It really comes down to optimization. Performance. Think of the Hyper VM as this dedicated high-speed highway, built only for trading, optimized purely for latency and throughput.
Got it.
The EVM is more like the public road system, where all the other applications live and interact. By keeping them separate, they basically guarantee that the core exchange's performance never gets bogged down, never compromised by, say, complex or high-gas smart contracts running on the general side.
Okay, so the separation preserves the speed, but how do these two systems talk to each other effectively?
Good point. They developed two key things for that. First, a system contract. This lets the EVM access critical L1 data, like real-time market data from the DEX directly.
I see.
And second, a native token transfer mechanism. This basically links their native spot assets from HIP1 with standard ERC20 versions on the EVM side. Interoperability.
Clever. So this whole dual architecture, it's designed to position Hyper EVM to maybe attract a lot of general finance activity.
That's the plan. Potentially, yeah. Maybe mirroring some of the success we saw with, say, BNB chain becoming the finance hub around Binance.
Interesting comparison. Okay, so that's pillar one, Hyper EVM. Pillar two is the one that hits our core tension head on. Validator decentralization, moving beyond just those 4 core team validators.
Exactly.
And as we said, critics are rightly skeptical. If that amazing performance was built on centralized control, how do they actually promise to keep that sub-second speed when they let in dozens of new, potentially less reliable validators?
They're addressing this with quite a sophisticated quality control layer. built right into the Hyper-BFT proof-of-stake consensus. It's a jailing mechanism. Think of it as their performance enforcement tool.
Yailing. Okay, how does that work?
So new validators wanting to join, they have to prove their performance. Specifically, they need to maintain sub 200 millisecond round-trip communication times with other validators. Consistently.
Sub 200 meters. That's fast. And if they fail, if they lag,
They get jailed. They can still relay messages around the network, so they don't totally drop off, but they lose the ability to propose new blocks or vote on them. They're effectively sidelined from consensus.
wow. So the message is clear. Performance is absolutely paramount. The network will sideline anyone dragging it down.
Pretty much, it's a strong signal.
And the good news, for the community at least, is that the testnet phase seems to be proving this is viable. The sources mentioned 39 whitelisted validators are participating right now.
That's right. And crucially, they're successfully maintaining those really strict sub 200 meters block times.
So that's the proof point, maybe. That decentralization doesn't automatically mean performance has to crash.
It's definitely a very encouraging sign, yeah.
Okay. And pillar 3, what's the final piece?
Pillar 3 really rounds out their commitment to credibility, I think. Open sourcing the Hyper-BFT consensus mechanism itself.
Ah, opening the kimono, so to speak.
Exactly. This won't happen immediately. It's planned for after the Hyper-EVM is stable and validator decentralization is well underway, but it's a clear signal, a direct challenge to other high-performance L1s out there, the Monads, Mega ETHs, Sonics. They're basically saying, we're not relying on some proprietary black box. Here's how we do it.
That's a bold move. Okay, this raises a really important question there. What do the actual users and builders think? The people relying on this platform day to day, how do they feel about this massive, complex shift?
Well, the consensus among traders seems really strong. We saw comments from names like Presto and Stalequant. They basically agree. The trading experience feels functionally identical to using a CEX.
Which is huge, right? That's a massive barrier psychologically and operationally that they seem to have crossed.
Absolutely. And Stalin made another interesting point. He felt Hyperliquid's volume seems more retail, like driven by lots of everyday traders, rather than just being dominated by a few huge HFT firms, which suggests real community activity.
Interesting. What about the builders? They're crucial if this hyper EVM thing is going to take off.
They seem equally bullish, actually. Protocols that are already building or planning to build, like Hyperlind and Felix, they were really attracted by the scalability claims, specifically that potential for 100,000 TPS on the new EVM layer.
100K TPS, yeah, that would attract attention.
And they also praised the core team, called them product-minded, pragmatic. Felix specifically highlighted their focus on useful features, things like recent precompiles.
Okay, can you just quickly unpack precompile for us in this context? What does that mean here?
Sure. Essentially, a precompile here is like a standardized communication bridge. Because you have those two separate VMs, remember, the fast trading engine and the general EVM.
Right.
Precompiles are special, efficient contracts that let builders on the EVM easily connect to and use data from the high-speed perp DX layer.
Ah, I see. So it allows, say, a lending app on the EVM to use real-time perp market data without lag.
Exactly. It enables that kind of composability between the two layers, makes building sophisticated DeFi apps easier.
Got it. That makes a lot of sense. And that potential for builders, it's strongly reinforced by the platform's existing foundation, isn't it? The Hyper EVM is predicted to attract massive new inflows, partly because it's already sitting on that huge liquidity base, that $700 million USDC.
Precisely. It's not starting from zero like most new L1s. And that liquidity, it's about to become much, much easier to access to.
How so?
The anticipated deployment of native USDC directly on Hyperliquid in Circle's cross-chain transfer protocol, CCTP.
Ah, CCTP. That's key.
Yeah. Right now, users have to brig USDC via Arbitrum first. It's an extra step.
Yeah.
CCCP would eliminate that, allow direct, efficient transfers from basically every major network straight onto Hyperliquid, unlocking even more liquidity flow.
Okay, so let's bring this together for you, the listener. What does all this mean? Hyperliquid seems to be in this unique, really powerful position. They've already solved the two biggest headaches new L1s always face, right? Establishing deep liquidity check, $700, and onboarding a large user base check, over 210,000 users. And they did all that before fully launching their generalized ecosystem with Hyper EVM.
Exactly. It means they're basically positioning themselves to try and consolidate the entire financial stack. Spot trading, perpetuals, lending, options, maybe more, all onto one single, incredibly high-performing platform. They built the killer app first, proved the market demand for it organically, and now they're building out the rest of the infrastructure to capture that whole financial segment.
It's a really compelling roadmap and built on a, frankly, rare technical foundation. But let's close out on maybe their core value proposition, thinking about investors, community members looking ahead.
I think the foundation, maybe the most differentiating thing long-term, is that decentralized token distribution strategy.
Ah, going back to the HYPE token launch.
Yeah. Unlike so many new L1s you see launching where, insiders, VCs, early teams hold a huge concentrated chunk of the supply. Hyperliquid's distribution, driven mainly by that 2-year trading points program, it's inherently highly decentralized from the get-go.
The sources estimated something quite specific there, didn't they?
They did. The estimate was that the top 10 token holders at Genesis, people who earn the most points presumably, they're projected to control less than 33% of the total supply combined.
Less than a third for the top 10.
Yeah.
That's actually quite distributed compared to many projects.
It really is. It signals a foundational commitment to community control, community alignment. So here's the final thought for you to consider. In a crypto landscape where investors seem increasingly focused on quality assets, on verifiable market demand, on genuinely loyal communities, does this foundational commitment to community control built on 2 solid years of proven organic trading activity, does that give Hyperliquid a crucial long-term edge? Especially compared to chains maybe more reliant on that centralized insider funding model, that's something you absolutely need to keep an eye on as this ecosystem unfolds.